Let's get to the hard data, because this is where the rubber meets the road. COMEX registered silver, that's the silver available for delivery against futures contracts, dropped from 89.6 million ounces in December 2023 to 47.3 million ounces as of February 1st, 2026. That's not a drawdown, that's a hemorrhage. We're talking 42.3 million ounces gone. And here's the kicker. Eligible silver, which is silver sitting in COMEX warehouses but not available for immediate delivery, is at 238.9 million ounces. Total COMEX silver is 286.2 million, but the registered category, the only one that matters for contract settlement, is at a 9-year low. Now let's look at premiums. SD Bullion, 485 over spot for generic rounds as of Monday morning. APMEX, 520 for American Silver Eagles. JM Bullion, 475 for Buffaloes. These are not normal premiums. Historical average is $1.80 to $2.40. We're running 150% to 180% above historical norms. That's not retail hysteria. That's structural tightness. And one more number. SLV, the big silver ETF, reported net outflows of 3.2 million ounces in January. That metal is going somewhere. It's either going into private vaults or it's being withdrawn to settle physical demand outside the paper system. Now connect the dots, because silver doesn't trade in a vacuum. This is where most YouTube channels lose the plot. They hype silver in isolation. That's not how markets work. Let's cross-reference. First, the DXY, the dollar index. As of Friday's close, we're sitting at 106.82. That's a breakdown from the 107.50 support that held for 6 weeks. If we lose 106.20 and we're only 62 basis points away, we're looking at a flush to 104.80, possibly 103.50. A weaker dollar is rocket fuel for dollar-denominated commodities. Silver has an inverse correlation to the DXY of 0.73 over the last 18 months. When the dollar drops, silver rips. Watch 106.20. That's your line. Second, the 10-year Treasury yield. We closed Friday at 4.41%. We've come down from 4.73% in mid-January. Falling yields mean lower opportunity cost for holding non-yielding assets like silver. If we break below 4.35%, which is the next technical support, you're going to see a bid come into precious metals hard. The 10-year and silver have a 0.68 correlation since Q4 2024. Yields down, silver up. It's not complicated. Third, Bitcoin. I know. T, why are you talking about Bitcoin on a silver video? Because the same macro forces are at play. Bitcoin closed at $96,450 on Friday. It's sitting in a symmetrical triangle between $94,800 support and $98,200 resistance. If Bitcoin breaks out above $98,200, it confirms risk-on sentiment, and silver, as a risk-on monetary metal, tends to follow with a 48 to 72-hour lag. If Bitcoin breaks down below $94,800, we get a risk-off flush, and silver could wick down to test support. But here's the thing, even in a risk-off scenario, physical silver tightness could create a floor. That's the anomaly we're watching. Fourth, gold. Silver's big brother closed at 2,167 per ounce Friday. The gold to silver ratio is sitting at 95.1. Historical mean is 72. When this ratio compresses, meaning silver outperforms gold, we typically see it happen violently. In 2020, the ratio went from 125 to 72 in 4 months. Silver went from $12 to $29. We're not saying that happens here, but the setup rhymes. If gold holds above $2,840 and makes a run at $2,900, silver should leverage that 2-to-1 or 3-to-1. Here's your fork in the road. I don't do hopium, I don't do doomerism, I do scenarios with specific levels. You decide which one the market is confirming. Silver holds $29.80 support. That's the key level. We tested it twice last week, Thursday and Friday, and bounced both times. If $29.80 holds, the next resistance is $31.40. That's the December 2024 high. If we clear $31.40 on volume, we're looking at a measured move to $34.20, then $35.80, and the ultimate target in this leg is $38.50. Why $38.50? That's the 1.618 Fibonacci extension from the October 2023 low to the May 2024 high, projected from the August 2024 pullback. It also aligns with the 2011-2013 resistance zone adjusted for inflation. 3850 is not a meme, it's a technical and macro confluence. The catalysts for the bull case: DXY breaks 106.20 and flushes to 104.80. The 10-year yield breaks 4.35% and heads to 4.15%. COMEX registered silver drops below 45 million ounces, triggering whispers of a delivery default. Physical premiums spike above 6 hours. Retail and small institutional buyers accelerate. And here's the sneaky one: a geopolitical event, Middle East, Eastern Europe, Taiwan Strait, that triggers a flight to hard assets. I'm not rooting for that, but I'm not naive either. In the bull case, you're watching for a weekly close above $31.40. If we get that, the momentum algos wake up, and we could see a 12% to 18% move in 4 to 6 weeks. The timeline is Q1 into early Q2 2026. Silver fails to hold $29.80. We get a breakdown, and the next support is $28.50. If $28.50 breaks, we're looking at $27.10, then the big one, $26.20. That's the August 2025 low and the 200-day moving average. If we lose $26.20, the bull market since October 2023 is in question, and we could see a retest of $24.80 or even $23.50. The catalysts for the bear case: the DXY finds support at 106.20 and bounces back to 108, rekindling dollar strength. The 10-year yield stabilizes or ticks back up to 4.55%, making treasuries more attractive than silver. COMEX registered silver stabilizes or even ticks up due to deliveries or reclassifications from eligible to registered. Physical premiums compress back to $3.50 or lower, indicating demand is cooling. And here's the big one: a risk-off event where liquidity dries up and everything sells off: stocks, crypto, commodities, and only treasuries and the dollar rally. In the bear case, you're watching for a daily close below $29.80, followed by a weekly close below $28.50. If we get that, the trade is risk management. You're either scaling out of leverage positions, tightening stops, or if you're physical only, you're just waiting it out, knowing the long-term thesis hasn't changed. So what do you watch in the next 24 to 72 hours? Let me give you 5 specific things. 1. COMEX warehouse reports. These come out daily, posted by the CME Group, usually by 10:30 a.m. Eastern. You're looking for the registered category. If we see another 1 to 2 million ounce drop this week, that's fuel. If registered ticks up by 3 to 5 million ounces, that's a red flag for the bull case short term. 2. The DXY daily close. We need to see 106.20 broken and held below. A daily close below 106.20, especially if it happens Monday or Tuesday, sets up the dollar for a deeper pullback, which is bullish for silver. Conversely, if DXY reclaims 107.20, the bear case gets stronger. 3. The 10-year Treasury yield. Watch for a break below 4.35%. If that happens, set an alert. The next leg down in yields could be fast, and silver will respond. 4. Physical premiums at major dealers. Check SD Bullion, APMEX, JM Bullion every morning. If premiums start pushing 550 to 6 withdrawals on generic rounds, that's a signal that physical tightness is intensifying. If premiums compress to $4 or below, demand is softening. 5. Silver's intraday behavior at $29.80. Does it hold on volume? Do we see aggressive buying on dips to $29.85 or $29.90? Or do we see weak bounces and lower highs? Price action tells you everything. If we're making lower highs and grinding toward $29.80, that's distribution. If we're making higher lows and holding above 30 euros, that's accumulation. Bonus: watch gold. If gold breaks $2,900 and runs, silver should follow. If gold fails at $2,875 and rolls over, silver's bull case is at risk. Zoom out for a second. Forget the day-to-day noise. What's actually happening here? We're in the late stage of a 40-year debt supercycle. Global debt to GDP is north of 340%. Central banks printed $18 trillion since 2020. The dollar's share of global reserves has dropped from 72% in 2000 to 58% in 2025. Central banks bought 1,037 metric tons of gold in 2024, the second highest year on record. De-dollarization is not a conspiracy theory. It's policy in Beijing, Moscow, New Delhi, and Riyadh. Silver is the lever on that trade. It's money, and it's industrial. It's in every solar panel, every EV, every 5G tower, every data center. The USGS estimates we have 20 years of silver reserves at current consumption rates. But consumption is accelerating. The Silver Institute projects a 200 million ounce supply deficit by 2028 if current trends continue. The COMEX paper market is trying to suppress price to manage that reality. But the physical market doesn't care about paper derivatives. It cares about ounces. And the ounces are disappearing. So what's the thesis? The thesis is this. Paper price discovery is breaking down. Physical is decoupling. When the registered COMEX inventory gets low enough, and we're talking sub 40 million ounces, the system faces a choice. Cash settle contracts and admit the paper market is a sham, or deliver physical and drain the remaining inventory, which accelerates the squeeze. Either way, the outcome is higher prices. The question is timing and path. Now, I want to hear from you. What are you seeing in your local market? Are coin shops sold out? Are premiums spiking? Are you buying this dip or waiting for $28? Drop currency T in the comments if you're tracking this with me. And if you haven't subscribed, hit that button. We do this every week. No hype, no BS, just data and intermarket analysis. Look, I don't know what will happen on Monday. I don't know if we rip to $34 or dip to $28. No one does, but I know the data, and the data says the physical market is tightening while the paper market is pretending everything's fine. That gap doesn't last forever. It closes, and when it closes violently. So stay sharp. Trust the data, not the headlines. Watch those 5 things I gave you. And remember, position size is everything. Don't bet the farm, but don't ignore the signal either. This is T for currency T. Out.